What are the mistakes that I made with my money? That's the topic for this week's wari-Q. So I recently wrote about this, and it touched a few nerves in the right way, I assume so. And I wanted to convert this into a video for all of you. So the context is, we grew up without money. My dad used to work in the pharma industry. My mom was a school teacher. Is a school teacher. Rather, was a school teacher, but my mom is still alive, so my mom is a school teacher. Was a school teacher? I don't know. Okay, you get the point. And we never really had money. We were always hand to mouth. There was never excess money. We were perpetually in debt because my dad quit his job, took another really fancy role. That company shut down. Then he was jobless for 2 years. We genuinely didn't have money for 2 years. My mom borrowed from friends, family, so on. Then he got another job, worked there, but then wasn't working out. So one fine day he just quit, started on his own. That accumulated a lot of losses. So just string of poor decisions. And I remember distinctly growing up hating money. I believe that money was the reason for all our misery. I believe that money was the reason why we weren't happy as a family. We didn't get to do the things that we wanted to. While we were a happy family, but we never had money. And because of that, I did not respect money. I never respected money. I wanted to have so much of it, like it was fuck you money. I had so much of money that I never respected it. But what I didn't realize was this mindset that I didn't respect money made money also never respect me. And I think I paid the price for that. Here are the mistakes that I made. Number one, I took loans to buy real estate. And the premise in my head was, I buy a house, it grows and it appreciates in value because everyone's houses appreciate in value. So even if I take a loan and pay a 10-12% interest, I will make way more money than that in the appreciation. And that's wrong. If you do the simple math, it's not going to happen. The house will have to appreciate like 20% year on year, but doesn't happen in real estate, by the way. And that means that if you take a loan of 10-12% to buy a house, and then you are hoping that that house appreciates, then you have to pay taxes on that house when you sell it, whatever is it, whether it's long-term capital gain or short-term capital gain, and then you have to pay the EMI for all the loans. So after you make all the deductions, you will not end up making money. I lost a lot of money because I did sell the house for more than I had bought, but whatever extra that I sold it for was far lesser than the interest I paid to the bank all these years. Stupid call. And because of this belief, whenever I got any extra cash, it was a bonus at work, it was some extra cash that has come from somewhere, I did not pay back my loans. It's just super crazy. And I just feel like this dumb guy who didn't know any better, which is, by the way, true. I didn't pay the loans. All that I did was invest in startups. I invested in startups, I became an angel investor, and I started putting in money because, again, with the same belief, startups will make me a lot more money than this loan payment will, because I will, of course, make more than 12%. That is the interest that I'm paying the bank. Never happened. Because angel investing is not about you striking gold. It's generally about the discipline, and I thought that was really easy, but clearly not. So all that I did was I basically went to a casino, convinced that I would make money that was enough to pay my loans. That's exactly what I did. I continued to invest in illiquid assets, real estate, startups. These are illiquid, which means that whenever I want to sell them, I can't sell them at my whim and fancy. I can't sell them when I want to sell them. There will be a point of time when I'll be able to sell them, and that needn't be when I want to or have to sell them. And I did not invest in liquid assets, stocks, mutual funds, gold, whatever. So what happens because of that is when we were in financial troubles, when for instance, Nearby was going through a really tough time, I had to lay off the team, took a massive salary cut at my behalf, I suddenly had no cash. I had paper wealth. I had paper wealth of Nearby stock. I had all the investments that I made in startups. I had houses that I could technically own. or actually owned, but on the bank's loan, but I didn't have money. I literally didn't have money to pay for my bills every month. And that is crazy. Like it's the worst way of making money, because you technically have a lot of money, but you don't have money because you don't have liquidity. For an entire decade, from the time that I was 30 all the way up to last year, I took lower than market salary and I over-indexed on equity. And almost every entrepreneur will tell you that that's the right thing to do. But here's the mistake that I made. When you take lower than market salary, you're essentially placing all your probability of success on that equity. And in the unfortunate event that things don't work out your way, which is quite likely they will not work out your way, because startups only have, a 20% mortality rate, and everyone else just dies. 20% success rate or mortality rate? 80% mortality rate. 20% success rate. And all of them die. You're basically saying that all the equity that I have planned for, I just have a 20% shot of making it work. So here's my recommendation: that cover for the financial base. Do not ever take less than market salary. And the investors will blame you for it. They will feel like, oh, you're not in it for the right thing. You will feel shitty about yourself because you're like this person of high morals and you don't want to take money or market salary from the company that you own. But all of that is honestly bullshit. I'm wiser now, and I recognize that if you are building your own company, the last thing you should not be doing is to not take a market salary. You're absolutely well within your right to be paying yourself adequately for living a life, for having some sort of an excess liquidity that in the moments of distress, in the moments when you need capital, you will have it. I over-indexed on the future. I continue to maintain my lifestyle when I should have lowered it. I should have sold the houses that I had. I should have forced my way to buy out or sell out of the angel investment that I made, even if that meant getting out of a discount or not getting as much price as I would have otherwise. But I maxed out my credit cards. I took even more debt, all in the hope that one fine mega event will happen. The equity will turn into cash. This big dream will unfold itself and I will make money. I invested in stocks when the markets were high in the hope of making quick money. I sold in panic when the markets were low because I didn't want to lose money. And that is just the worst way of doing it. It's the exact opposite of what one should do. I invested when it was high. I sold when it was low. It's exactly the opposite of what I should have done. Whenever in need of money, the few fixed deposits, mutual funds that I had, I just broke them. I didn't break that bloody illiquid asset, that real estate. I broke the liquidity. And what I broke by that is the compounding. Because they had been there for 3 years, 4 years, 5 years. They'd begun to just literally start taking off with that compounding piece, and I just broke that rhythm. I just broke that rhythm because I needed that money, and I wasn't any wise enough to say, this is not to be broken. I should be breaking the illiquid assets. I discouraged my wife from investing in mutual funds and fixed deposits. I laughed at her. I mocked her. She still did it. But I basically said, you're a fool. You're not like the cool one. You're not the one investing in the real cool stuff, the startups and so on. You're like boring, orthodox, conventional mutual fund fixed deposit. But the truth is, it was her investments that saved us. Not once, thrice. Because I hated money, I never respected it. And I realized that money didn't respect me either. And that was the biggest takeaway. And today I think I know. Here are the lessons that I've learned. Number one, taxes are a thing. Taxes are real. And always look at your tax-adjusted returns when you're comparing different investments that you make. Inflation is a thing. It's a real thing. Your money will lose value over time. So take that into account whenever you're investing, wherever it is that you're investing. Compounding rests on a very important element, and that is time. Compounding is pegged on time. So you need time to witness compounding in action, to see it deliver the magic that it can deliver. Give it time, a lot of time, as much as you can. 10 years, 15 years, 20 years, even more. Liquidity is critical, as I said. Invest in something that you can withdraw cash from when you need it. Else, what's the point? If you have excess cash, wait. If you have excess cash, wait for the right opportunity, wait patiently, wait for the markets to drop, wait for the right investment to come in. Wait, wait, wait. Hold on to that cash. Don't be impatient, just wait. Because if you buy at the right price, your returns will be determined by that. I love Warren Buffett's quote that he says, "No one wants to get rich slowly." And that's why I am rich and most people are not. He didn't say that, but that's the derivation. When in your 20s, live like a pauper. When in your 20s, live like a poor person. Live within your means. Pay your bills and then pay yourself by investing. Don't pay for your desires. Pay for your desires the last if you have any money saved. Pay for that phone, that car, that everything that you want the last. First pay your bills and then pay for yourself in terms of investing. And do not take loans for your desires. Do not take loans for your desires. The only two loans that I would perhaps encourage you to take is one for education and two for the house that you stay in. Even that is a stretch, but I recognize that a house is a big deal, so you may not have that income. Most of us don't. But nothing beyond these two. Not a loan for a car, not a loan for a bike, not a loan for a phone, nothing. Never. Always, always debt free. Do not invest according to your echo chambers. Because I'm from the startup community, I felt like startup investing is the coolest thing ever. You could be a commodity trader or from a family of business and you'll think that commodities, gold and silver is the best thing ever. You could be from a family of stockbrokers and you'll feel that stockbroking is the best thing ever. Nothing's the best thing ever. You have to find what works for you according to your risk profile, what is your appetite, how long do you want to invest, how much can you invest, and so on. So go outside of your echo chamber and understand what is it that people are doing with their money. Double down on what is working rather than diversify. Diversification will not yield supernormal results. If you know that something's working, whether it's a startup that you're invested in, whether it's a stock in a particular company that is doing exceptionally well, put in more money in there, double down on what's working. That is the momentum theory. If something is doing well, it will continue to do well. There is no explanation for that, but that's such an important theory in stock trading. You monetize that. Don't diversify. Don't spread yourself so thin that your returns will then come back to the normal thing that everyone gets. Allow compounding to happen. As I said, it takes time, decades, but allow it to happen. The biggest lesson that I've learned about money is that money will not buy you happiness. Money will not buy you peace. Money will not buy you such things, but money will buy you something very important, and that's freedom. Because freedom is a privilege. And I didn't have this freedom for the longest time in my life. But today I realize that it is important, and today I have it in a way that I feel so blessed. Because if you have freedom and money gives you that freedom, you have the freedom to make mistakes, you have the freedom to make choices, you have the freedom to choose what is it that you want to spend your time on and how and why. And that freedom is powerful. It's a privilege. And very few people in this world get that freedom and get to experience that freedom. And if you were wise with your money, which I'm so hopeful you are, I learned the hard way, and at 40 I'm finally in control of my money. But you're in your 20s and you have such a wonderful time ahead of you. You're earning, you can be wise about this. Do not make the same mistakes that I made. Go and manage your money and grow your money the smart way, and then you will never, ever feel like you're stuck, because you would have earned what money will give.